Hey everyone, this is Brent from Wolf on Wall Street Trade and thetechnicaltake.net. Well, the Fed finally cut rates, the first rate cut of the cycle. Bloomberg surveyed 114 economists, asked them what they thought the Fed would do. 25 basis points or 50 basis points of that 114, only 9 got it right. The majority were expecting a 25 basis point cut, so a lot of people are calling this a panic rate cut by the Fed. So we went through quad witching option expiration on Friday, which means we're about ready to turn into Q4. A lot of times funds will move their positioning at the turn of the quarter. I am going to tell you what I think this means, what I think the historical probabilities mean, and some ideas of how we're going to probably position into Q4 of 2024 and into 2025. So let's jump right in. First, the panic rate cut. A fun little fact you may not have been aware of: 17 years to the day, September 19th, they cut rates by 50 basis points. You can see it here, and here is our rate cut over here. The gray area is recession shading. So if you've watched my videos, certainly if you are a subscriber to my service, you know that my mantra is pretty much that the Fed cuts rates into a recession like this. I'll show you some more. This is the Fed funds rate, the effective Fed funds rate. These gray areas are recession shading. You can see the dates down here. I just want to show you something because I've talked about this a lot. The Fed hikes, the Fed pauses, usually when the 2-year yield drops below the Fed funds rate, and then they cut into a recession like this. So again, hike and then a pause and then cut into a recession. Same thing over here. This is the great financial crisis, by the way. Hike, pause, cut into a recession. Hike, pause. This was the COVID crash. So again, cut into a recession. We were at hike and pause, and now we have the first cut. I am a little bit of a market nerd, so I actually kept notes on the chart. I'm going to share those with you. Here is a daily chart of the S&P 500 rolled back to 2005, 6, 2007. The Fed cut the discount rate a little bit before the Fed funds rate, but that's a different story. Here is their first rate cut 17 years ago to the day, as I was just talking about. And you can see the market response to a 50 basis point cut was strong. That was, again, September. If we roll forward a little bit, the market topped in 2007 in October. And there's the top. And the Fed keeps cutting rates. So if we just roll forward, you'll see a lot of rate cuts. Sometimes you get a big surprise, and the market, in this instance, puts it in a counter trend rally because we've already started a little bit of a downtrend. Sometimes we get cuts like this, right? That the market comes down. If we just keep moving forward, a surprise cut over here, market bounces, a 25 basis point cut here, the market comes down a little bit. And then we really start to move into the kind of meat of the financial crisis, right down here. So you can see the Fed has been cutting all the way down to zero. So this is a little bit of history of why I often say that the Fed tends to cut right into a recession. Here is the 2s, 10s Treasury yield curve. And again, we have recession shading. You can see the years down here. So the warning, generally speaking, of a recession is when the yield curve inverts like this. Okay, so you can see it over here. Remember, the recession shading is gray. You can see it over here. Even right before the COVID crash, it did invert a little bit, barely perceptible on this chart. In this cycle, it inverted the most in 4 decades. So that's kind of the warning, but that generally means that a recession is still, 16 months, 24 months sometimes off. It is this sharp steepening right after the curve inverts that is kind of the imminent signal of a recession. So if you look before every one of these recessions shaded in gray, you'll see this really sharp steepening of that 2s, 10s yield curve. And what does that? What causes this curve to steepen? And by the way, the 2s, 10s yield curve right now steepened about 11 basis points last week out of inversion, which is this black line. What causes that? It is the Fed cutting rates. So let me show you a chart of the NASDAQ back in the tech bubble and what the Fed was doing back there. I happen to have notes again. So here's QQQ 1999. This is the tech bubble, right? There was some stuff going on with Y2K. So if anybody is that old and remembers, but everybody was kind of really afraid that when the year 2000 rolled around that it would confuse the computers and maybe the world would shut down. So the Fed injected liquidity into the market right before Y2K. So in 1999, that boosted stocks a lot. And you can see the Fed is still hiking rates over here, 25 basis points. And you can see my note over here, the yield curve is starting to invert. And there is the top of the tech bubble. The Fed is still hiking rates at this point. So if you talk to like old traders, the general rule of thumb is sell the third Fed rate cut in a rate cut cycle. We just got the first. That's not always true. So when we saw the S&P in 2007, that first rate cut in September of 2007, saw the market top the very next month in October. Here we can see the NASDAQ has already topped. The Fed is still hiking rates. Here's the pause. Remember, Fed rate hike, then pause, and then they cut into a recession. So the curve is starting to steepen, and you can see the Fed is cutting rates now late. If you look at the S&P, it's like a completely different picture, but this was really the tech-led bubble, right? So that's why we're looking at QQQ. And if we just kind of move forward, you can see the Fed cuts rates all the way down. And this was a rather long recession. We had September 11th, 2001, of course, in there too. But it was a fairly shallow recession. It wasn't a really bad recession. So you can see where it ends in the market, where it kind of bottoms. And the Fed is still cutting rates. Okay, so Fed cutting all the way down again. But my point is you can't really count on that generalization of sell the third rate cut. If you want, you can pause the video on this chart from Bank of America, and basically it shows the Fed funds rate and all of the cuts that were in response or led into some kind of crisis. So all the way back here, 1929 Wall Street crash, the Latin American debt bubble, stock market crash in 87, long-term capital management, the tech bubble that we just looked at here, the subprime crisis, tech bubble, subprime crisis, COVID, and where we are now with just starting to cut rates. So again, you can see why I say with probabilities that the Fed tends to cut rates right into a recession or some kind of crisis. Why would the Fed panic right now? I'll tell you why. Employment. This is the unemployment rate from the U.S. Bureau of Labor Statistics, and you can get this chart if you want from the St. Louis Fed's website, Fred database, or this one is from Trading Economics. You can see what the trend is in unemployment. And here's the unemployment rate with recession shading on, and you can see where we are now, which is pretty elevated compared to where we were going into some of these recessions. So it's already very elevated. The Fed has two congressional mandates. That is maximum employment, which is this chart, and stable prices, which is inflation. So to fight inflation, of course, they hiked rates. And it may have something to do with the fact also that 818,000 jobs were revised away from BLS payrolls for the year ending March 2024. So as I've been saying in a lot of my videos for about 2 years, there's a lot that has not added up in the Bureau of Labor Statistics employment reports. Now we know why, or at least now we have more evidence why almost 1 million jobs that were reported as having been gained were revised away. I am pretty sure that spooked the Fed. So real quickly about that 25 versus 50 basis point cut and all the economists that got it wrong, the vast majority, you really don't have to be an economist to figure this stuff out. All right, you can look at the Fed funds futures. The CBOE has a great FedWatch tool that breaks it all down for you. So before the Fed went in the media blackout, they were set at basically 25 basis points. Anytime the probabilities go above 50%, the Fed almost never disappoints. So going into media blackout before the FOMC, it was a pretty solid 25 basis point cut, right? If you looked at the Fed funds futures, they started moving during this media blackout, and the probabilities started favoring 50 basis points, like strongly. There is one surefire way right now to know what's going on with the Fed. They leak what they want to do so they don't surprise markets, and all you have to do, you don't have to be an economist, you just have to know who they leak to, and who they leak to is Nick Timiraos of the Wall Street Journal. So before, about a week before the FOMC, we're getting all these articles, and Timiraos is either on Twitter or he's on the Wall Street Journal. All these economists, you don't need the PhD. It's not even doing them any good. Just pay attention to the Fed funds futures and pay attention to the people they leak to. Let's talk real quick about the probabilities of soft landing. Basically, we have no recession or a very shallow recession, which is what the stock market anyway, is pricing in right now. Some examples of the Fed engineering a soft landing would be 1984, 1995, and 2019. So this chart you're looking at may look a little confusing at first, but it's something you've seen in this video. The first one is the 210 yield curve in blue, right? So when it dips below this black line, it is in inversion. Like I said, we had in this cycle the deepest inversion of the yield curve in 4 decades. So that's what you're looking at here in blue, recession shading in gray, and the Fed funds rate in red. So let's go through some of these soft landings, like when the Fed cut rates over here in 1984, and we had what would be considered a soft landing, or the Fed cut rates here in 1995, and we had what would be considered a soft landing, or 2019. Actually, we did go into recession, but COVID was a whole other thing, so this is an oddball. But what I wanted to point out was, look at what the yield curve was doing at these points in times. It was not inverted at any of these points in time. It is inverted, or was inverted, until the Fed just started cutting rates last week. Now, so as far as the soft landing, is it a possibility? Of course it's a possibility. Is it a probability? That's what we're talking about. I don't think it's a probability. The alternative is a hard landing or a recession. Carrying on with that idea of the soft landing, have another chart here I'm going to have to explain to you real quick. It's a little confusing, I know. But again, you're looking at the Fed funds rate in red over here, recession shading in gray. This is the 1980s, so that's inflation resurged, and we had a Fed funds rate of 20% back then. It was crazy. And the blue line is the unemployment rate. So again, if we look at those periods where we did have soft landings as the Fed cut, 1984, 1995, 2019, look at the unemployment rate, what it was doing. So for instance, in 1984, it was barely, moving up. So it was moving up. The Fed started cutting rates over here, and they avoided a recession. Yield curves were not inverted. 1995, here is the unemployment rate. And here we are now. And this green line is the high of the recent unemployment rate, so you can compare to these soft landings in 1995, 2019 over here, and 1984 over there. So unemployment rate already at a much higher level. And then we have the Sahm rule. So Claudia Sahm is an economist, or was an economist with the Fed, that wrote the Sahm rule, which is actually kind of borrowed from somebody else. But in any case, you can see recessions here in gray going back to the 1950s. And the Sahm rule, which basically states that if the 3-month average of the unemployment rate moves 50 basis points above the lowest point of the unemployment rate over the last 12 months, that you are already in a recession. So 50 basis points. The Sahm rule triggered 2 payroll reports ago at 53 basis points, and the last payroll report at 57. So here it is, There has only been one failure that I can see of the Sahm rule, which was back here in 1976. It hit exactly 50, so it was at the very bare minimum threshold. Every other time when the Sahm rule has triggered at least 50, we've already been in a recession. So technically we're not in a recession right now, but recessions are always identified in hindsight. I'm not saying that we're in a recession right now, but this is not a good sign to already have a reading this high, whereas in any case in the past, we were already in a recession when the Sahm rule triggered at 50. Now, the market is so interested in the soft landing narrative because there's a big difference between a soft landing and a hard landing, historically speaking anyway. So if we look at like 1984, 1995, 2019, you have positive stock returns in the S&P of about 10% 6 months after the first rate cut, when you have what might be called like a hard cut, right? Returns are very different. So usually 3 months after the first rate cut, the S&P is about 6% lower in a hard cut scenario. So big difference, and that's why a lot of investors right now are really hoping for that soft landing. So going forward, a few things you want to be aware of and keep an eye out for is any kind of stress in the financial system. So you can watch like the secured overnight financing rate. You can get that on the Fed website. That's the St. Louis Fed's website. Any payrolls reports that come out like less than 100,000 job gains, although it's really hard to trust the payrolls report right now, being that we just saw almost 1 million jobs revised away in a year. Any kind of sub 100K payrolls report, rising delinquencies, stuff like that, that's what you're going to be looking out for. As far as opportunities, one opportunity I can think of right now, because I listened to the press conference, as painful as it was and as bad as I felt for Powell. Powell is basically saying the neutral rate is going to be higher. He thinks the neutral rate or the terminal rate will be higher, which means he doesn't expect the Fed to cut down to 0% again. Going back to a chart of the Fed funds rate and recessions, I can tell you it takes about 500 to 550 basis points of rate cuts to deal with a recession. So back here, it's probably around 9.75 or so, and by the time they were done cutting rates, it was down at 3. So you're talking about 675 basis points of rate cuts. Back here in 2000, let's say that's, I think, maybe 6.5%, and that comes down to 1%. So there is your basically 550 basis points of rate cuts. Over here, 5.5%, basically down to 0%. They left it at 0% for 7 years. You get the point I'm kind of making, is about 550 basis points of rate cuts, which is basically where we were right before the Fed just made this last rate cut. So Powell is saying he thinks the terminal rate is higher, that they're not going to go to 0. So that opens an opportunity for a trade long euro dollars. We had one of these back here. A couple of our members took it. I think they did pretty well with it. Basically, it's a trade that is betting that the Fed is going to have to cut a lot more than they are thinking or that they are saying. So the Fed took the Fed funds rate all the way back down to 0. And anybody who got on that long euro dollar trade at that point where it didn't look like, or the Fed wasn't indicating that it would be headed that low, they made some good money. So that is a potential, especially if Powell keeps on talking about the neutral rate or the terminal rate being higher. What's next? Heading into Q4 and Q4 bleeding into 2025. One of the interesting things that happened right after the Fed cut rates that night was yields were higher. My feeling is that the market sees this cut as maybe being, whether it's too big or not, it doesn't really matter. When the Fed cuts rates, what happens is the dollar goes lower and dollar-denominated assets move higher. So when the Fed cuts rates, there is a potential of causing inflation, which is why the Fed waited until September. If you remember back in December of 2023, the market was pricing in 7 rate cuts for this year starting in March, but we had a little bump in inflation. Fed couldn't cut in March, they couldn't cut in June. inflation is much, much more difficult to deal with for a central bank than a recession or unemployment. Now, of course, I'm not an economist, but I like to have a macro overlay. I like to have like a map that says you are here and have some idea of which way we're heading. From the data I'm looking at, I think we are heading into growth decelerating, and because of this rate cut, inflation accelerating. And I'm not saying like 1970s or even like early 1980s, like crazy inflation, but just a bump. That's exactly what we saw the first half of this year, why the Fed couldn't cut in March. And just a bump is very dangerous with unemployment moving up, because that means it could tie the Fed's hands from any further rate cuts or stall those rate cuts. Unemployment would be getting worse. So here's a quick chart of the Consumer Price Index, CPI. Remember that inflation bump I talked about? Wasn't huge, wasn't like a big, thing, but it was enough to tie the Fed's hands and they couldn't cut in March. That calmed down, and that calming down of inflation is what allowed the Fed to cut here in September. So I think we are going to see another bump in inflation. As far as growth, if we look at ISM Manufacturing PMI, growth is headed down. ISM Manufacturing PMI new orders trending down. ISM Manufacturing Production trending down. ISM Manufacturing Prices Paid. Here is that inflation bump in the first half of 2024, right? It comes down and allows the Fed to cut. It is trending up a teeny bit, but I think this is probably going to get a little bit worse if commodities do what I think they're going to do because of the Fed rate cut, ironically. And here is the ISM Services PMI. So, of course, the United States is no longer a manufacturing powerhouse. We outsourced all that. So services, we're a services economy. Basically 70% of our economy is services. So this is a little bit all over the place. You want to watch how the services do. But as far as growth, like what we're seeing in manufacturing and stuff like that, it's headed down, and you know why I think inflation could be headed up. Very simple explanation is dovish Fed policy equals a lower dollar, and that means things priced in dollars move higher. And speaking of PhDs, one of the things that we are watching that's on our radar for either potential trades or just getting the feel of the macro environment as we move into the new quarter and then the new year is Dr. Copper. So Copper has a PhD in inflation deflation, and I will prove it to you. So here is copper futures on a 4-hour chart. Here is the first half of the year inflation bump. Here is inflation coming down. But if we take a closer look at this chart, something interesting is happening. You'll notice if you're a longtime subscriber or a longtime watcher of my videos, I don't usually define trends with trend lines or moving averages. I define them by higher highs and higher lows, which is an uptrend, or lower highs and lower lows, which is a downtrend. So we are going to look at this area right over here a little bit more closely as we're moving into Q4. And you can see August 5th over here, August 12th, so you know where we are. We have a low, right? And we have a higher low. So this is a trend that is in transition at this point. We basically have an area of resistance for copper at 431. And this week, after the Fed cut rates, what happened? Copper broke out and made a higher high. So we went from a downtrend to now what is a transitional trend, a higher low, a higher high. Copper is starting to move higher. You can play copper on the long side if you so desire to, or you can just keep an eye on it with the ETF CPER. The commodity that I'm watching the most, especially in light of what is going on with Israel and Lebanon right now, is oil. So let's pull up WTI crude futures real quick. And this is a 12-hour chart. I'm just going to back it up a little bit. Check out the dates here down on the bottom. I want to move back to the beginning of the year. So remember that inflationary bump. And I actually anticipated this by watching crude oil and a few other assets. But here's that inflationary bump for about the first half of 2024 that kept the Fed on hold. And they couldn't cut rates as soon as they wanted to. And then here it is kind of topping and then coming down. So let's move up to where we are now. So we do have a downtrend, right? We have higher lows and, lower highs and lower lows. And we have this area of resistance right in this area. I would call it probably like, to break through it really convincingly, I'd say 73, 74, something like that. And volume is really not very impressive over here. If you look at volume on this little kind of counter trend bounce, right? So volume is falling. Oil doesn't look all that impressive. The U.S. administration, or the Biden administration, is basically draining the Cushing hub. First, they drained the strategic petroleum reserve to keep gas prices low, and now Cushing is the Cushing hub's almost empty. If we do see a political flare-up or geopolitical flare-up with maybe Iran getting involved and saying, hey, we're going to shut down the Strait of Hormuz, because there is a choke point at the Strait of Hormuz that they could shut down if they wanted to, that would send energy prices soaring, and energy prices have a very, very high correlation to yields. They tend to lead yields by a couple weeks. I'll show you that real quick. So what you're looking at in the price candlesticks, the red and green, is USO, which is the United States Oil Fund, and the blue line is the 10-year yield. So you can see when oil tops out, a couple weeks later, yields top out. Again, oil bounces over here, comes down, yields come down. My point being, to this kind of inflationary outlook into Q4 in 2025, oil is a big one to be watching. And for another reason, CTAs are completely short oil, and CTAs can really move stuff. They're basically rules-based trend followers. And hedge funds are the most bearish of oil in history. So they are short. So it's really, really, really easy to power a huge short squeeze. But to do that, you've got to give them some reason why, like a move maybe above 72, 73 in that area might start a short squeeze, which will feed on itself and send oil prices even higher. So right now, oil is not flashing any yellow or red flags, but it's definitely something to keep a really close eye on. Another group of assets that we're going to be watching that tend to do well when the dollar gets weaker. And let me just pull up a chart real quick of the dollar. So the dollar and yields are kind of acting the same way. They're both reflecting Fed policy. They're both reflecting inflation deflation. So you can see the dollar index over here kind of bumping up the first half of the year a little bit and then coming down as we saw inflation come down. About this 150 level, I expect the US dollar index is going to break that, and that's going to start sending dollar denominated assets higher. Some of the assets that tend to do really well as far as stocks go, emerging markets. So for members, my first post of the cash session Thursday morning after the Fed cut was all about these assets that I think can do well into Q4. And it included emerging markets. Emerging markets tend to do well when the dollar is weaker. Here's EEM for emerging markets. This is not one that I highlighted in that post, and the name of that post for members was, I think it was Reflation in Q4. EEM I don't like just because it's really heavily weighted towards China, and China's economic growth right now is not great. But there are several other emerging market countries that I did include in that post. Here's INFL ETF, the Inflation Beneficiaries ETF. This is one that we're going to keep an eye on, but this could be one that can add some more to this really nice gain. When it comes to currencies, it's all about which central bank is more hawkish, which one's more dovish. So right now, compared to the Fed, the Bank of England is going to be more hawkish, which is going to make the pound probably do a lot better versus the dollar. So a way to play that would be FXB. So this is the ETF for the British pound. You can see where I'm going with these ideas, right? They're all basically based on dollar weakness, based on the Fed having a pretty decent size rate cut right out of the gate. As far as style factors, we've seen a real breakdown in market leadership. in Q3, especially in the AI trade. The semiconductors just not acting well like they were. They're not leading the market like they were. In the conditions that I described, if we get what I expect, which is lower growth, higher inflation into Q4, into 2025, some of the sectors that should do well would include stuff like utilities. And you know the defensive trade has been acting really well, but not all the defensive sectors like consumer staples will do well with inflation. So utilities would be one, REITs would be one, energy for obvious reasons, as we were just looking at WTI crude. And of course, as we talked about, emerging markets, but not China, unless the PBOC or the Chinese government announces massive stimulus. If they do, then China's on the radar. As far as general market conditions, as I just said, semiconductors really lost their mojo in July, so in Q3, which is something we kind of expected. Let me pull up the SOX index. So you can see over here we have the high, and then we have some lower highs, and what I think is starting to look like a little bit of a head and shoulders kind of top. So it's not huge, but that would be the left shoulder. This would be the head, and we'd be working on the right shoulder. This, of course, would be the neckline. And because it's an index, we don't have any volume here. But if we look at the ETF for it, SMH, and if I just rough in it, this isn't going to be perfect, but if I just rough in kind of a trend line, just to give us an idea of what we're looking at here, and then we look at volume, what you should see in a healthy market is advancing volume on price advances and then declining volume on pullbacks like this. Now, when you're at this first kind of left shoulder, volume doesn't make any difference at all, but as you get into the head and coming down the head, volume gets increasingly important in verifying something like a head and shoulders. And if we look at the volume here for SMH, what you see is like on this decline over here, we see volume increasing, right? On this advance, volume's barely even breaking above the 200-day average, but on the decline, volume is increasing again. On this advance, again, not even at the 200-day average, just a little teeny pullback over here and volume increases. This is not a good sign, and we're kind of seeing this market-wide too, so it's not just in semiconductors. If you look at the SPY, as we get into Q3 over here, you can see a real change in volume. Like the green volume on the up days, it's not even breaking the 200-day average, but any kind of like pullback volume is getting pretty heavy, and we see the same thing in QQQ. If you look at this advance, there's no green volume above that 200-day average of volume, but you look at this decline and volume is increasing. This is toppy kind of price action or price volume action, so it's not great. One final thing I want to address, I completely understand hedging downside risk ahead of the Fed, ahead of the FOMC. I get it. And we saw some of that in the CBOE SKU index. If you don't know what the SKU index is, basically what it shows us is managers are hedging downside risk. So we see some of that downside hedging. They're buying deep out of the money puts in case there is a black swan event. What I don't get is the day after the FOMC, this thing made a record high, the highest in history, almost printing at 172. So this is not hedging unknown risk ahead of the FOMC. This happened the day after, Thursday. And the fact that it came down a little bit doesn't matter at all. They have 30 days of protection going out. So that's a lot of information to take in. I hope it wasn't too much, but you can always pause the video or go back and listen. If you like the video, please give it a thumbs up. Don't forget to subscribe to the channel so you know when new videos come out. Hit that notification bell down at the bottom somewhere over here, I think. Hopefully at least you have some idea of the things you can look for going forward into Q4. If you are a subscriber and you were busy last week and you didn't have a chance to read Thursday morning's post, the first post of the cash market, not the AM update, check that out. It is called Reflation in Q4. And if you're not a subscriber, you can still subscribe at 2008 rates before we move to the technical take, and prices will go up there. So hope you enjoyed it. Everyone, enjoy the rest of your weekend, whatever's left of it. And members, I'll see you on Monday morning.